Hey everybody, welcome back to today's Market Explained, a four-star media experience here. I'm Brian Castle, your host. I'm here with my co-host, Mr. Chris Reardon.
Afternoon, everyone. Glad to be here. Glad to talk a little bit about the markets and what's going on out there.
And everybody, Chris is our Director of Development, and he runs all the development aspects of Four-Star Wealth, the firm, national firm headquartered here out of Chicago in our home city. He has a burgeoning young family, and he's a great guy. So, Chris, again, welcome to the podcast.
Thanks, Brian.
And I'm Brian Castle, your original host and CEO and founder of FourStar Wealth Advisors. I'm a advisor to CEOs and insiders of companies, wealthy investors. I'm the husband to the amazing Tripty and dad to Quinn and Evan. So that's the lineup for today. If you like what we're doing, everybody, please give us a 5 out of 5 ranking on Apple iTunes. That's where all the rankings happen. We'd appreciate that. That helps our numbers and helps everybody see us when they look at the rankings and they can hop on our show. So we're going to talk a little bit about the markets today and what's going on in the world. There's a lot of interesting things, a lot of really, I mean, we thought we'd seen it all, Chris, but now we're seeing some very interesting things we haven't seen in a long time in the markets. So why don't we get started with talking about the markets and then we'll talk about other things we see out there. So go ahead, Chris. What do you
Yep.
have for us today?
Yeah, so a little bit of change, kind of a bit of the same to a degree with the asset class rankings. So we still have international equities leading the way. It's at 294 tally points and gained 2 points from the last podcast, so continues to kind of firm up in that number one position. Domestic equities is still in second at 282 tally points, and it gained five, so a slight um, convergence there between international and domestic. We'll see if that continues. We could see domestic overtake international, but every time it's kind of happened, we've never seen domestic make enough of a consistent push to really overtake international. So we'll see if that happens here. Commodities, meanwhile, has kind of started to pull back again. It was approaching dropping out of the 200s before a bit of a resurgence back up to about 225, and now has fallen back 7 points since the last podcast to 218. So it's kind of falling back again. And then the bottom three, which are the more kind of conservative asset classes, have still been relatively stagnant. Cash is in fourth at 118 tally points, and that's unchanged. Currencies is at in fifth, and that's at 95 tally points. It lost 1 point since last podcast, and fixed income is still in dead last or sixth place, and it is at 80 tally points and unchanged. So not a whole lot of change. I mean, I think the biggest is we're still seeing consistent upwards momentum and movement from international and domestic equities. Commodities tends to just be kind of a bit of a what's going on, if you will, out there, because it's either feast or famine, it seems.
Yeah.
They're surging 25 points or kind of pulling back. So, we'll see if any of that changes. But flipping over to kind of sector performance, we do have a bit of a switch here. So, top performing sectors, we have a new number one. It took almost 6 months now for energy to be displaced as the number one sector. But now we have information technology, the number one sector, with a 28.31% year-to-date return. So the AI fuel, if you will, that has been powering semiconductors, software, chips, all that has continued to kind of power that sector upwards. Energy now falls to the second position. It's up 26.28% year to date. So still very close. It still is almost a 1-2, 28 and 26% with information and technology. As far as leading sectors. Industrials is in third, and it's a bit of a drop off. So now we go down to industrials, which is up 14.38%. And it held that, so it didn't move up or down since the last podcast. Materials moved up one spot. It's up 12.51% year to date. Real estate dropped one, and that's up 8.36% year to date. And then consumer staples is kind of that top half that rounds it out. That's up in sixth place, and that's up 5.94%, unchanged year to date. So as far as ranking, And then bottom performing sector. So now utilities is at 4.23. Didn't change as far as ranking wise. So it's still in seventh. Consumer discretionary, we're starting to see a little bit of momentum with that moved up one spot. It's up 2.46% in eighth position. Communication services dropped one spot, which is kind of interesting because a lot of that parallels with technology. But we just haven't seen that momentum flow over into that communication services yet. That's up 1.95% year to date. And like I said, it dropped one spot when it was overtaken by consumer discretionary. And then the last two continue to be healthcare in the 10th position, and it is actually negative 2.88%, unchanged as far as positioning wise. And financials is last. It's down negative 4.85%, and unchanged. So the bottom two are negative year to date, positioning wise overall. So really interesting. We finally, as I said, we energy got unseated in that number one position for the first time so far this year. So we'll see if that continues. I mean, all it would really take is a little bit of friction out of the kind of Iran conflict for energy to make a little bit of a spike. So we could see some kind of jousting back and forth potentially, depending on what happens geopolitically. So.
So Chris, there's not a lot of change in the groups, but it is kind of interesting that the technology that was terrible in the first quarter has come all the way back up to number one.
Yeah, I mean, it's been pretty, I would say incredible, if you will. But it's AI, which was kind of singular to a degree. It was really impacting one or two different names, has just kind of almost just spread out. Now you're seeing names such as Dell, you're seeing, the Oracles, the CrowdStrikes. It is literally, it's like tendrils impacting all these different software and chip. Intel is another great example. It's just driving all these. You have SanDisk, so memory providers. So it's really been this catalyst that's caused this huge jump we've seen after, like you said, Brian, a pretty sluggish Q1 really for technology. We've seen it really reignited by this AI craze, you could call it right now, I'd say.
Yeah, it was like a 6 month swoon because the fourth quarter was tough too. And now it's come roaring back and we're in this 9 week melt up. And then today's Tuesday the 2nd. So yesterday was an up day, new records. Today is started down, now it's up. So we might have a 10th week in a row here, possibly, of market. That hasn't happened more than I think 4 or 5 times in market history that we've had 9 weeks in a row. Pretty crazy. Um, and Chris, the other thing that's happening is we're starting to get emails from investors we know. Hey, do we own Micron? Hey, do we own this? Hey, do we own that? Because they keep seeing that they're going up 10 and 20% a week. It reminds me of in the 2000 era, the internet boom, original boom, when AOL was going up $5 a day and everyone was piling in. And of course, it ended badly. It usually does end badly. So I'm sure this will end somehow, hopefully not badly. But we're seeing that same kind of like mania going on right now for those technology names.
Yeah, and talking about records, the stock market now has done something that's only been seen once in the last 100 years. It's now setting consecutive all-time highs, which both the S&P and Nasdaq has, alongside the highest PCE inflation reading in nearly 3 years. Usually, when you have these high inflation readings, we see that temper the stock market a little bit because the expectation is high inflation readings, maybe higher interest rates, which is going to stem off the stock market. So we are kind of seeing this weird divergence, if you will, an unusual divergence in the stock market going on right now, where even though we're getting slightly hotter reads, especially in the PCE, which we'll cover in a little bit, the stock market just has kind of slugged that off and really has been enraptured, if you will, by this AI play. And it's probably only going to get worse before it gets better in some ways, just because right now we have almost an IPO mania going on with SpaceX. We have Anthropic and ChatGPT or OpenAI. So it's going to be, in some ways, I think a little worse just because I think that's going to feed even more into a lot of this.
Well, and Chris, these manias, we've seen some of these, the internet boom in the 98 through 2000 era. That was one I remember well. This is looking very much like that. And they can end badly. The internet boom did end badly, where people bought the Munder NetNet fund, which was Munder Capital out of Michigan. And they were actually down almost 90% from the year 2000 until year 2002. 90%, which is unbelievable. Or they can just stop going up, like the stock Microsoft had a really hot period of time, and then it went down a little bit and it just sat there flat for almost 10 years and didn't do much as the market caught up to everything else. So we'll see how this ends. It'll end. The mania will end, and it's a mania. There's no doubt about it. It's just a question
Mhm.
of how it'll end and how badly, what are the characteristics of the end. We'll see.
Yeah, no, definitely. And I mean, I think, like you said, it could just kind of sputter out. We could have a couple names that are, overvalued, if you will. But it'll definitely end at some point. We'll see kind of what happens. I think the key thing to point out there is, that AI.com bubble is, even though the internet, as far as impact to the world was everything it promised. AI can certainly still be there, but that doesn't mean that these stocks might necessarily be overpriced or just overvalued at this point. So it's important to note that. I mean, I think the AI technology is here to stay for the most part. It is going to have a huge impact, but we'll see if we have some either a kind of a drag or a steady consolidation with some of these stocks, or we see a big pullback. And we could have it, both ways, if you will. We could have a handful of names that got bid up, that small caps that just skyrocketed, that come back to earth. And we have the large caps, the Nvidias that just kind of patter out for the next 2 or 3 years as they consolidate their growth.
Yeah, a lot of money has been already made in these names, and probably a lot more will be made. And we certainly can't predict when this will slow down. But you look at the multiples of some of these names, they'd have to grow at the rate of like 100% for the next decade to justify the multiples that they're at now. So it's unrealistic to believe that'll happen. It's good, and tech, and the AI is here to stay. It's making everything more efficient. It's getting a little bit of backlash too, because the general talk is they're causing layoffs, and they are at some companies as things are more efficient. But a lot of companies now are actually just keeping the current staff they have and just making those staff members more efficient and helping the growth of the company. So AI doesn't need to mean layoffs. It could be more efficiencies and better growth. And aren't we seeing that in earnings, Chris?
Yeah, I
From
mean,
some numbers?
we're
Yeah.
certainly seeing that with earnings overall. I mean, I think some 80% or so of earnings in the first quarter beat their estimates. And we're seeing I think it's about 26% year-over-year earnings growth on average.
Mhm.
So we're certainly seeing that played out. And I mean, I think what the crux of the US economy has always been the productivity, and we've seen really productivity has been stagnant for the last 20 years almost. It's just, you can say almost 15, 20 years. And so what we could see potentially, on the extremely rosy side, if you will, is that AI comes in and boosts that productivity. We keep the same labor force, but our GDP output overall is just increased, right? So
Mhm.
each person that is employed is just has more productivity per unit or per person. So, uh,
Mhm.
that would be the best case scenario. And I'm sure there's going to be certain aspects of that, and there are going to be certain disruptions. I think some industries are just kind of primed for, if you will. So, just like anything that's a disruptor, the internet is a great example. It's
Mhm.
definitely going to have some winners and losers, I think, overall.
Yeah. Well, and we're seeing this whole set of names gallop upward. Say like last week, 20% for certain of these names, Micron, and some of the other chip names. Now, these were lower multiple names that were not leading the market. And as you said, it took a long time for the information technology group to come back to number one. Even though we've had these record moves, it took a long time to unwind their negative trend. But now it's so positive, it's out of control. But at some point, they will continue to go up and go up and go up, and at some point they'll stop. But these were not the top names. They were below market averages. And I know, Chris, you've got some numbers, I believe, on multiples and where we are on all that. Why don't we go through some of that?
Yeah, and so I mean, going over to I guess the U.S. economics, if you will, um, you know, the Q1 2026 GDP came out, so that's got revised down to 1.6 annualized. This is the second estimate. It was released kind of end of May. The initial was 2.0, so a slight revision down. People were still anticipating the consensus was holding at a 2.0 level, so a slight pullback there. And Q4 2025 GDP was also revised down slightly, 0.5%. So, once again, this is kind of feeding that underlying, are we seeing some disruption kind of underneath the hood, if you will. Personal income decreased slightly as well in April. So it was down kind of negative 0.1 billion across the whole US. Disposable personal income fell. And then personal consumption expenditures increased. So we're looking, and I think this is anticipated. Households are spending more, but earning less in real terms. So that means, I think households overall right now are spending more on gasoline, food prices, things like that, and they're just not seeing. So that inflation is starting to outpace a little bit. We kind of talked about it on a more of a percentage basis. I think either the last podcast or two podcasts ago, but we're starting to see that eat into that real number for the U.S. households. And flipping over to the inflation, the April PCE price index, this is that what we were kind of referring to on that record we were talking about, was up 3.8% year over year. That's the highest reading since August 2023. And a little bit more of an acceleration we saw from the March PCE number, which was 3.5%.
Yep.
So we continue to see a slight uptick there, PCE. Um, that's the Fed's preferred rate, kind of measurement, if you will, that they like to look at. So it'll be really interesting if we start to see, and I think as of right now, what this high PCE reading really kind of factored in is, I think right now there's zero rate cuts being factored in for 2026 so far. That could change certainly, but obviously the market's going to react systematically to what goes on. Right now, it's looking more and more like potentially no rate cuts at all in 2026. So we'll see. We did just have the new how it's called Fed chair Kevin Warsh
Mm-hmm.
get
Mm-hmm.
sworn in. That was like May 22nd, I want to say. So June will be kind of the first official meeting for him. So that'll be I think a big inflection point of how is he reading the markets, things like that.
Mm-hmm.
I think the inflation is still a heavy concern probably for them, but I think the key will be is the inflation really tied to what's going on in the Middle East, or is it here to stay? There's always going to be a certain element, for of that gasoline prices, things like that being flowed through to food prices, things like that. But what impact and how long will that stay? So going over to
Yeah.
consumer sentiment, the University of Michigan Consumer Sentiment Index for the early May reading hit 48.2. The final May reading was released, I think towards the tail end of last week, and it came in exactly at 48.2 still. So, I think a lot of that's feeding off of the Iran peace deal optimism, and higher gas prices are the major factors that were noted there. Going over to the housing market, mortgage rates ticked up. So we have the 30-year fixed is at 60.60%. So we're really starting to see that bite a little bit into the housing market. 70% of the nation's 100 largest metro areas remained overvalued per Cotality, which is just a kind of one of those analyst companies. The monthly principal and interest payment on the medium priced home at current rates consumes approximately 24% of the typical family monthly income. So we've kind of felt this, I think, a lot. And I think at some point something's going to have to give, especially if interest rates are going to remain this high, or they're going to have to see interest rates come down to accommodate, the current housing prices, or we're going to have to see housing prices come down. Just because,
Mhm.
when we have this, it's not as sustainable. So we'll see what happens there if we have any impact. And then the last
Yeah.
little bit I'll touch on in the job market. April payrolls came in at plus 115,000, which beat expectations significantly. And I think that plays a lot into what you were talking about, Brian, and that, even though there are certainly some job cuts that are happening, I think, where we primarily see it, and we saw this even in the last couple of years in a lot of these tech companies, that I think in many ways overhired, over the COVID period, and over a lot of that, there was a lot of overhiring. So that's where you get a lot of these big headline numbers. But overall, when you look at manufacturing, you look at healthcare, you look at all these underlying, there still is a decently strong jobs market. We'll have May payrolls being released this week, so that'll be a big data point that the Fed's going to look at as far as, how's the jobs market holding up? How's the consumer, how's the household holding up? One interesting thing to note, the federal government employment continues to decline. It was down about 9,000 jobs in April. That's continuing a multi-month trend as the DOGE-related workforce reductions across agencies continue. That hasn't been obviously in the spotlight as much. It was kind of obviously a big thing right in the beginning, but they are continuing to do that, and I think they are trying to reduce, the government workforce where they can. So I think that continues to be, very important. And then the last little bit I'll touch on, initial jobless claims for the week, kind of mid-May week, remain in the 210 to $220,000 range, which is consistent with the slowly cooling but not deteriorating at all labor market. So, overall jobs market seems decent. I think inflation is still something we're kind of, to keep a close eye on. I think that's kind of the biggest, the inflation and the impact we could have there on the housing market.
Very interesting. Well, speaking of the housing market, Chris, you talked about how prices have stayed high. That's obviously because the market seems stuck. We've talked about this on previous episodes. That really hasn't changed. I mean, the market appears just basically the only other way to describe it is stuck. That not a lot of properties are selling. Record low transactions in the real estate brokerage industry is causing consolidation among real estate brokerages. They have high fixed costs, unfortunately, a lot of the old traditional brokerage firms, and so they can't really just pivot that quickly. So they need to merge, and they need to find a way to manage their costs, and it's been really difficult. And meanwhile, it's keeping prices high. And since now you say, Chris, Trump had hoped rates would go lower, that would help the economy grow and might cause a little bit of inflation. It doesn't look like that's going to happen either. It looks like rates, if anything, could go up, right?
Yeah.
Well, that's certainly not going to help the real estate market. The real estate market needs rates to go lower to unleash some of that property. So there's tons of properties that are there, and there's also an estimated 1.5 to 2 million properties of seniors that don't want to sell their property because of tax reasons. They'll let the property become part of their estate. But if they were to change some of those rules, we thought they might do that. They haven't done that either. They could actually unleash some of that property into the market with a family that could use a 5-bedroom home instead of having one or two seniors living in a 5-bedroom home. So there's a lot of aspects of the real estate market that are a little stuck right now, the residential real estate market. And on the other hand, it's a feeding frenzy in the commercial real estate market with property prices way down and lease rates way down, percentage occupancy still way down from COVID. So there's a lot of different characteristics of the different parts of the real estate market, but the residential real estate market is decidedly stuck. So,
Yeah, and I think, there's still a lot of building going on. I mean, I think they're still trying to, but that's another tough one because commodity prices have still, depending on the area, have still been relatively high. Copper continues to be extreme highs, and that's what a lot of piping is used, things like that. So conduit. So I mean, it's not as simple as just build homes, because if the inputs you're using to build the homes, make that home, you have to sell it for, say, 600,000. It doesn't, you're not, taking a home necessarily and selling it for, a $200,000 home or something like that, depending on the area. So, it's a tough problem to solve. And, I don't know if it's going to get solved necessarily overnight. But
Mhm.
hopefully we have some smart people in Washington that can help kind of figure out a way to kind of unstuck the stalemate going on right now.
Brian Castle. I'm the CEO and founder of FourStar Wealth Advisors. Now, we built FourStar on one simple belief that every client deserves clarity, confidence, and strategy built around their financial story. For over 40 years, we've guided clients through every market cycle, helping business owners, families, retirees protect what they built and then grow their holdings to meet the needs over their entire life for them and their family in the future. We are fiduciaries, not salespeople, and that means we sit on the same side of the table as you always. So, from personalized portfolios to advanced tax and estate strategies, everything we do is about creating long-term freedom and peace of mind for our investing families. So if you're ready to align your wealth with your goals, visit fourstarwealth.com. Let's start building your future one smart decision at a time. Yeah. So what else do we have in the economy, Chris?
Yeah, so I'll flip over to commodities real quick. I'll touch on. There's the two big ones I'll just touch on. Obviously, oil. So Brent crude kind of settled down right now, trading at about 93, 106 a barrel. We've seen that whipsaw, depending on the news coming out. If there's Iran deal optimism, we see it kind of maybe move a little bit below that. The re-escalation, it'll spike up. So but one just interesting thing to note is that average kind of 98 bucks a barrel, call it, is still approximately 45 to 50% above pre-conflict levels. So no matter what, we're still going to see probably an elevated gas prices at the pump and oil prices overall. So it'll be interesting to see if we do get kind of a deal or something there that's going to kind of solidify that, what that ultimately settles down at.
Yep.
I think that'll be important. Um, then going to gold real quick. So gold was trading at all-time highs near 4,724. It's since pulled back into the kind of 44.50, 45.40 range. So a little bit. That was at the end of May. But gold still remains really structurally supported. So Q1 2026 demand for gold hit a record 193 billion globally. And that's for central banks, ETFs, and bar and coin buyers. All remain net buyers. So we're still, even at these extremely elevated levels, we still see a lot of net buyers. JP Morgan is still saying their target gold by year end is at $5,000 an ounce. So still higher than where it is now. I think some of the volatility we might see there is, whenever you see a stronger dollar, and that would be usually the dollar strengthens if interest rates are going to be going up, or even staying the same in some circumstances, that usually impacts gold. So we could see that fluctuate ultimately, but it seems like there's a big support level of people that, for whatever reason, and we've talked about it on this podcast, whether it be the high debt levels in the US, concerns, things like that, that want to buy gold. They see that as a more safe asset class to be in than potentially just owning, US dollars. So gold and oil, I think, continue to be kind of the big main players right now. You also have silver, which kind of runs a little bit underneath gold, and that's started to kind of bottom a little bit here. I think the silver lining with silver, it also tends to be a primary industrial metal for a lot of electronics, things like that, semiconductors. So there is going to be that demand there, but we haven't really seen that re-accelerate back up after it had that huge run similar to gold, earlier this year and last year. So
Mhm.
those are the two primary as far as commodities, but what we're seeing there.
Very interesting. Well, and we're seeing all this movement in oil, and people are wondering, if we're the largest oil producer in the world, why are we affected by the price? But it is a worldwide price. It's high, it's worse in Europe because they still have to import everything, so there's import costs and everything. But we still are affected by it here in America. And so we are the largest producer of oil, but there are certain parts of it, like we still import diesel, even though we export gasoline, right? So there's a lot of nuance to it that maybe people don't realize.
Yeah, yeah. I mean, I think the important distinction there is the type of oil. Not all oil is created equal, if you will. So,
Right.
diesel oil is very different, obviously, than unleaded gasoline oil, things like that. So I think that's why you see drastically different changes there. The Permian Basin and certain bases within the U.S. don't produce the heavier crude oil that is usually used for like diesel per se. We have more of kind of a light sweet oil, if you will, that's better for maybe gasoline prices. So there is a nuance to it. It isn't just kind of a zero sum, hey, we can produce our own and we don't have to worry about the market, if you will.
Right, exactly. Well, and all that translating into relatively high pricing on the financial markets as well. And energy was one of the strongest groups, obviously, up until recently when IT took over as number one. But when you look at the overall, though, Chris, after all this talk and all the stuff going on in the economy, the forward-looking PE is about 21 times, I believe, right? And that includes all those AI stocks. But if you back out that technology sector, specifically all those AI stocks, the multiple overall for the market is not at a record level. The price of the indexes are, and that's the nature of a bull market. And it was that way in the 80s, that way in the 90s. Whenever the bull market is on, usually every year, every day that it goes up, there's a new record, right? Because we're at the high. So that's what we're kind of seeing right now. But is the overall market wildly overpriced? It doesn't look like it, but certainly those AI stocks are.
No, yeah. I mean, I think for sure. I mean, I think the interesting thing with the AI is there's even some AI related stocks. We talked a little bit about the Intels and the Dells that even though they've run up, I mean, they're still a very good value. I mean, you look at some of these and they're these giant behemoths that have been around since the dot-com bubble that have just kind of been stagnant, but there's
Mhm.
still these giant, it's not a small little startup with very little revenue. So I mean, I think we're seeing almost a little bit of a reinvention, if you will, that's bringing a lot of these even behemoth companies that have their earnings there to prove it, kind of back into the more mainstream tech environment. So it's kind of a broadening, if you will, of the tech market to some degree, I would say.
Yes. And it is interesting too, like as I've watched the markets over the years and I got involved in the early 80s, the information flow to investors was different than it is now. Now there's so much information, so many TV shows, there's pop-ups on your phone. We didn't even have iPhones until 2006, right? So now all of a sudden that was the first time Apple introduced the iPhone. So now I have all these things popping up on our phone constantly, and that leads into investor behavior. Chris, one of the services that we use, the Dorsey Wright service, they have a thing where for each week, all the people that use their service will plug in different quotes and they can see who asks, what quotes are the most asked for. And usually that'll tell you where all the excitement is in the market. And in the past week, they had Micron, MU, Apple, AAPL, NVIDIA, and Microsoft. They had Palantir, Intel, and Dell. So all the names we just talked about, all those hot names. And so those are the names that have had the most people request a quote for, right? Or they're pulling up a chart or something in that system. And then that's ironically, no surprise, where all the activity is in the market. All those stocks are running up. We're seeing like this kind of internet melt up like the year 2000, where the stocks are going up 10% a week or 5% a week or something like that. And it's pretty crazy.
No, I mean exactly. And I mean, there are, I think certain, certain stances. I'll talk a little bit when we get to what we see out there, but I mean, I think for the most part, we still have a pretty strong economy, and I think manufacturing, and then there's a lot of certain areas that just remain, still very strong, and I think there's a lot to be hopeful about with the way the current economy is.
Yes. Chris, there's another ratio that has been talked about lately. It's the CAPE ratio. It's basically an inflation adjusted price earnings ratio. And, the historical readings are at a CAPE of 10 or less. It's a good value, good time to buy. 25 or more is considered high. could indicate a huge future crash. And the historical median of this CAPE ratio over time is about 16. Well, the CAPE ratio is at 40 right now. So it's way, way beyond even a higher level than one would expect. Now, of course, just because this ratio is so high doesn't mean it's not necessarily predictive value. Doesn't mean that the market's going to go down tomorrow. I remember in the summer of 1987 when the long Treasury bond went over 10%, and the strategist of Shearson Lehman Brothers got on our squawk box and said, we're now seeing a wildly overvalued market, a lot of competition from the bond market if you can get a higher yield. And that's what's happening in the bond market right now. Rates are going higher. So there's competition for stocks, but it took till, much later in the year for the market to start to sell off. And then there was a computer created crash in 1987 that really wasn't related to the economy. And it turns out the economy was okay in 1987. We never actually saw a recession, but the markets corrected because things were overvalued. So that's where we are now. So we have a wildly overvalued CAPE index. We have a higher than normal overall value, but there still are some good values in certain other groups. Certainly, banks and other groups are negative for the year, right? Healthcare is negative for the year. So there's some groups that are of value. I will caution folks, though, if we do have a big sell-off in the market, even though certain groups are cheap, they all go lower. Everything that's cheap, I remember in the fall of 2007, when the markets were not wildly overpriced, but certain groups were once again. And then the market started to sell off into 2008. Then we did have a serious economic problem in 2008. But even the groups that were cheap got a little cheaper, right? Everything went down. So there's nowhere to hide in a bad market, unfortunately. So you have to be careful out there. So anyway, well, that's just some chatter on the market, historical perspective. We're in a rising and melting up market. We might have our 10th week in a row. We'll see what it looks like Wednesday, Thursday, and Friday, as far as like the markets being up, which would be an all-time record, I believe.
Yeah. Yeah. I mean, we're at that. It's funny. I think you had mentioned this one time to me, Brian, but you sometimes when you're watching, whether it's CNBC or Bloomberg or whoever, Fox Business, you always see that flashing, S&P at new record, S&P at new record, NASDAQ. And it's like, if it closed at a record the first time and it happens to be up the next day, then it's always going to be hitting a new record. So they make it sound like it's the biggest thing, when it's just, hey, it was essentially up today and it's at a new record. So every day it's up, it's going to be a new record.
Yeah. So what do we see out there, Chris?
Yeah, so kind of touching on that, Micron's been one of the darlings of kind of the AI, and it's a little bit of a derivative play because it's more memory. But Micron is the latest company to hit the 1 trillion market cap, and hit it kind of towards the end of May after shares surged 19%. What's interesting about it is Micron went from 500 billion to 1 trillion in just 45 days. So it essentially doubled in 45 days as far as the market cap's concerned, which is extremely fast. Looking back at Tesla, some of the likes of that, Nvidia, Amazon. I mean, it took them in some cases up to 300, 500 days, I should say, or a year to 5 days to kind of hit that doubling. So a really record movement there, but high bandwidth memory, which is what Micron kind of makes, it now makes up roughly 2/3 of total AI chip component costs. So, we're really seeing that global shortage on, memory driving the demand right now for Micron and these chips and these memory chips, which is really driving that stock up, at least in the short term. And then keeping on that AI front, they just came out over the weekend that I believe it was OpenAI's ChatGPT solved a 80-year-old math problem that stumped humans for over 80 years. It's from these kind of they're Erdos problems, I think they're called. These equations that a lot of mathematicians use to kind of test to see, if you can solve the proof, how far, math has come really. And this one particular proof or solution has stumped people, haven't been able to solve it. And it took about 30, I think it was maybe 3 hours, sorry, for the OpenAI to solve the proof and proof it out. So I think that just goes to, A, that's incredible. B, this is what AI is really good at, right? Thinking systematically through a problem like that and just kind of proofing it out. That is really what it's set for. But I think it shows where we really even haven't scratched the surface yet. And even in sectors like you mentioned, Brian, healthcare, even banking, we haven't really seen AI get applied, I think, to levels that I think could really help accelerate, say, in healthcare, drug trials, things like that, and help proof out those and really drive a revolution or within there and see more solutions come to health issues that we're running into. So yeah, I think that this was just a really cool way of showing, hey, AI is here and it's going to hopefully accelerate human learning and human research and development, kind of coming into the future now.
Absolutely.
So then that's it.
Okay, well, couple things I want to mention, and I think we mentioned this in a previous show, but I just wanted to reiterate it. One of the biggest discoveries of lithium has been made in the mountains of West Virginia. And so it's, obviously a rare earth type metals. There's other metals that are being mined. We're talking to a lot of rare earth metal companies and investing in some of them. And the federal government is very aggressively trying to get more and more of these different compounds and metals in our stable, as previous administrations had sold off a lot of our metals and to foreign countries, including China. So we're kind of exposed there. Trump was actually negotiating with President Xi to get access to some of the metals that we had sold them, and I think they did some good because they were negotiating right during the time of the Straits of Hormuz being closed, and China was very vulnerable to getting oil and America was controlling it, so they had to cut a deal. So I thought that was interesting, but we're starting to see some rare earth metals being made available in America again. So it's going to take some time to mine all that, but at least we have some stores coming on. Chris, one interesting thing I noticed that we've seen a much broader use lately of celebrities. I don't know if anybody has been watching, like on Fox and CNBC, but there's these commercials for an investment called Venue, which is a company that makes kind of pop-up concert venues. And they have Troy Aikman on TV, the former quarterback. Now he's an NFL analyst. And we're investors actually in Venue. So for full disclosure, but Troy is now shilling for Venue. We also saw political leader, former California governor candidate Larry Elder, and country star John Risch, and a whole bunch of other famous race car drivers for Y-Refi, another company that we're investors for in our diversified alternative fund. So they're using a lot more political leaders and celebrities to sell investments, and they have disclaimers all over it, of course, and everybody has to be careful. You have to be appropriate. You have to be accredited. All these different things. But it's important that people be the right kind of investor for these things. But they're using celebrities now more and more to get people interested. I thought that was an interesting trend.
Yeah, I mean, certainly.
Couple other things, Chris, and we're just kind of hitting some random things. The United Nations has now withdrawn their worst case climate conclusion. Countries shut down from production. Folks lost their jobs. All the climate hysteria has now been proven wrong. And so a lot of folks are like, well, I guess they overdid it. Al Gore's worst predictions didn't come true in that video that he made a number of years ago. So now some folks are saying, now, wait a minute, there was all this talk about climate change. They changed the name from global warming to climate change. And they spent literally billions of dollars working on solutions for something that turns out not to be totally true. And so now there's folks saying there needs to be a reckoning. They're talking about reparations for different political groups or racial groups. Now they're talking about reparations for all the folks that, spent money. The taxpayers could go after governments for spending money on climate change or this kind of whole climate science without any real facts behind it. And so there were always scientists out there who were saying that was true. And they said there were no facts, there's no facts, but there were a whole crowd of people and a whole lot of money that went toward it. And now they've actually come out and proven that it wasn't true. And so also there was a group a political party in America that was fighting for higher oil prices because they wanted everybody to go over to the other side to wind and solar and other forms of energy. Now that same group, talk about hypocrisy, is trying to tell you that prices are high and it's Trump's fault. So it just, people tend to make kind of political decisions about some of these things. And now oil prices are high. They want oil prices to go low, but this is the same crowd that used to want oil prices higher. So it's kind of an interesting situation. I guess sometimes there are facts, and then there's how we view them and how we message them. And people tend to make decisions like that. Certain people for their own political interests, if you will. So there you go, Chris.
Sounds good. Yeah.
Um, Lately, we've seen a lot of speakers at college commencements talking about AI and getting booed as well. So we just went through college commencement season, and there's going to be a few more. Interesting that, like we said earlier in our discussion, you don't necessarily need to lay people off if there's efficiencies. You could take those same employees and make them more efficient and give them more tasks, more things to do, and make the company more efficient, make earnings growth more efficient. So we're seeing more and more companies do that rather than laying off people. Um, I also wanted to mention about Venezuela is now starting to show strong output growth. President Trump, rather than opting for regime change when they arrested Maduro in Venezuela, kept the rest of the team in place and is working with them. Major international oil companies are activating previously mothballed rigs. They're developing now. So the output that used to be 3 million barrels a day out of Venezuela got below $1 million barrels a day. It's back over 1 million and going in the right direction. So that's good news. And we've got Venezuela going back in the right direction. Also, one other thing, again, and these are just random things that we see, what we see out there. The Supreme Court confirmed the confidentiality of donors. Now, we've seen folks on the right try to use donations of people who are involved in Planned Parenthood against them, and they try to, go after them and get their names and, claim that they're bad people because they're donating to this organization. We've seen the same thing on the other side, where people are getting, attacked for conservative donations as well. So the Supreme Court reconfirmed that political donations and nonprofit donations are supposed to be confidential, right? So we're seeing a lot of, kind of clarifying of some of the rules. So our job is to help investors, Chris, navigate these difficult environments. So we always like to say, what are we doing about it, right? Well, we have this FourStar protection plan. Protection plan is such that when the markets are fully invested, we're fully invested, just like anybody normally would be to try to make gains. But when things are rough, we find ways to minimize the downside, and we'll raise cash. So until recently, until just this week, Chris, as you know, our numbers were still showing a little bit of weakness in certain areas, and we didn't get fully invested until just recently. But now we are fully invested, and we'll stay that way until things turn down. But we don't see that right now, do we?
No, no. I mean, it seems like right now, things are kind of firing on all cylinders. So I mean, like you said, Brian, until we start to see either some movement, if you will, on some of the triggers or underlying conditions that would cause us to retrench, we're going to stay fully invested.
Absolutely. So, but when things change, we'll talk about it right here, what we're doing about it. We don't change on a dime. We don't, go from fully invested to maximum cash overnight. It's a process to get in and get out. It's instead of like a light switch, it's like a dimmer switch. We ramp up and ramp down the risk, right? Depending on conditions. And so we've been able successfully to only sustain about 1/3 of the decline of a market. Let's say it's down 30%, we'll be down 8 to 10. So we're not down near as much, and that's really a key thing. So that's one of the things that FourStar tries to do to attempt, if you invest in the markets over time, you should get good returns. Our job is to try to get even better returns by maybe beating the market during advances, and then also beating it on the downside, which is much harder to do. And most investors don't. They just panic and they get hit, and the market goes down, and then they make bad decisions at the bottom where the market goes down and they're in a panic. So they sell near the bottom and then it goes up, right? So we try to sell along the way and not be holding all that risk all the way down. We often don't know how far down markets are going to go. When the market went down 55% in 2008, went down 70% in the 1970s, from 1973 to 1975, it went down over 70%. So you just never know how long these market declines are going to be. But we'd rather just pivot and get off to the side a little bit and avoid some of that. And then there's not as much stress, right? You have a lot of cash. You're sitting there. You're waiting for the market to bottom. It'll bottom wherever it bottoms, and then you see a succession of movements back up. Higher highs and higher lows are same indicators that got us out will get us back in, and that's the way we play it. So I think that's all we have for today, Chris.
Yeah, I think that covers it.
Hey, thanks everybody for being with us on the FourStar's Today's Market Explained. We will be back again with another episode here in a couple weeks. Welcome to June. Welcome to summer. FourStar Today's Market Explained. Over and out. Bye, everybody.